Okay, so no change in rates, no change in stance as expected. I guess the only surprise was the growth forecast for FY25 not being tinkered. With that, let's quickly get you a summary of everything that the governor announced for this policy. The repo rate, of course, being left unchanged at 6.5% with a 5:1 vote. That is, one MPC member dissented on the repo rate action. The stance has been left unchanged as well. On the growth front, you have a 7% projection being maintained for FY25, with the first quarter seen slightly lower now at 7.1% compared to 7.2 earlier. The second quarter at 6.9% growth versus 6.8 earlier. The third and the fourth quarter growth rate seen at 7%. On inflation, RBI said it is going to remain watchful of the developments around crude prices and also on the food inflation, which continues to play spoil sport, but core inflation is something that they take comfort from. For FY25, the CPI projection unchanged at 4.5% for the first quarter. It has been marginally revised lower to 4.9% for the second quarter, again lower at 3.8%, maintained for the third quarter at 4.6%, and slightly lower again for the fourth quarter at 4.5%. Besides this, on liquidity, as the markets expected, the RBI said it is going to remain nimble with its operations, but nothing, to really prepare the markets for what happens when, the bond inflows start coming in from June, or when the government spending picks up. But RBI again saying it is going to remain nimble. Interesting comment on the inflation coming in, that 2 years ago this time the inflation had peaked at 7.8%, and now we're standing at a juncture where the elephant in the room, that was inflation, has taken a walk to the forest, and RBI hopes that it remains there. Apart from this, RBI reiterating that they have enough and more forex buffers, forex reserves at all-time highs to deal with any currency fluctuations. In terms of non-policy measures that were announced, there's a scheme for trading of sovereign green bonds at IFSC, which will be announced shortly. There is an undertaking of a comprehensive review of the LCR liquidity framework for banks, a draft circular for which will be issued shortly. Dealing in rupee interest rate derivative products will be allowed for all small finance banks. And then, of course, there are some, the usual announcements on UPI, some on CBDC as well. So that is the large takeaway. Status quo policy, as expected. The surprise was on growth not being revised upwards. Let me quickly toss it to Latha Venkatesh back there for her editor's take on what the governor said. Latha.
I guess this is the flattest policy I've ever heard. I mean, the only hope we were having of some drama would be if they would up the growth forecast, because it was already there in the bulletin. But, bulletin forecasts get the sanctity only when they enter the MPC statement. Since that's not there, we have to go with 7. So that one small surprise we were expecting, upside surprise, hasn't come. It's absolutely on predictable lines. I think he's trying very hard to say that, he's not going to cut anytime soon. If I remember right, the word inflation figures in the first paragraph or the second paragraph where he talks about inflation probably a dozen times. I lost count. But nevertheless, I took a quick poll from the market. Most people are expecting the first cut in October, and no one has changed their mind. I can tell you how flat the policy is from the way the 10-year moved. The 10-year was at 7.110 before the speech began. It went to 7.11 and remained there. That's how the market has taken it. So entirely on expected lines. Even the inflation figure, although there's some changes in the quarterly mix, the overall inflation forecast for the current year remains the same. I think the only surprise element was that paper that they're going to circulate on LCR, that is the liquidity requirements of bank, how much they have to keep as liquid cash, in high quality government bonds. There is a paper that's going to be circulated. We can see if there'll be any changes, but it looks like it'll only be tinkering. But on that note, let me toss it to the biggest banker who is with us, Mr. CS Shetty, of the Managing Director of State Bank of India, is with us. Mr. Shetty, that was the only thing which was a bit of a surprise, the LCR paper to be circulated. Are you expecting any changes? That and any other comments on the policy?
Thank you, Latha. I think, as you mentioned, is broadly on the expected lines. A couple of things, of course, which I would like to borrow from the governor's speech itself, is that the liquidity management being nimble and flexible. I think that we could witness in the last few weeks that the liquidity is not constrained in the system, and whenever liquidity is excess, I think the absorption was done, and when the shortfall is noticed, I think injection was done. So to that extent, I think what governor has assured us in terms of being nimble and flexible is reassuring. On the LCR front, I think the banking currently is 24/7, with the mobile banking adoption and large-scale adoption by the UPI in India also we see. Even RTGS is 24/7 today, which means that the utilization of the banking facilities and withdrawal of money, while it is very unusual case, but it's a fact that the liquidity management in the banks has become more complex. And we also have been talking to the regulator informally that there is a need for looking at the LCR framework. We will await the draft guidelines and see what is coming in there. But I think the concern of the regulator is that probably there could be a little more buffers to be maintained. The large banks like SBI have substantial liquidity buffers over the minimum regulatory LCR requirement of 100%. So while it may be true for the large banks, I think in the system level, there's a need for maintaining the adequate LCR. Probably that is the reason why the RBI is contemplating to relook at the framework. So let's wait for the draft guidelines and see what is coming in there.
Okay. Yeah, I would assume that it can't be anything dramatic. These are largely Basel norms, the liquidity. Mr. Shetty, just one more word. He seemed a little confident on the capex cycle taking over, the private capex cycle. Of course, government capex is doing fine. What's your own sense now that we know that for the moment policy rates are not changing? First of all, do you all expect further transmission? Because he seems to be betting on that. Further hikes are possible in the deposit rate. And secondly, capex cycle.
So I'll first address the capex cycle. We see that I fully agree that the private capex cycle is much more broad-based now. While we had the initial capex commitments coming mainly from the renewables and roads, the capex cycle is private capex cycle particularly is broad-based. We see the improved utilization of our working capital facilities, and which indicates the capacity utilizations have gone up, which again in his speech governor has mentioned. Again I said the capex commitments from the private sector are coming across the sectors, both in terms of the brownfield expansions as well as the new greenfield commitments what they're announcing. I think I fully agree with that, that the private capital cycle seems to be moving in the right direction.
Okay, well, for the markets, it's absolutely sanguine in terms of a reaction. In fact, you'd probably want to say that it's a tad bit positive considering that the mid-caps have moved up. So the mid-cap index is up around 231 odd points post the policy. We have the Bank Nifty, which is marginally higher by around 88 odd points. Upasna, wanted to get your thoughts in. It sounded as though the RBI was much more sanguine about inflation as compared to earlier.
Yes, I think one, I would say that the overall policy is absolutely status quo in line with expectations, no surprises really. And it's a fairly balanced tone, if you just look at what's happening globally, US Treasury yields are higher, crude oil prices have moved up $10 from the last policy to now, dollar index is higher, rupee is weaker. If you just look at all of this, clearly the risks are increasing. And yet, the governor did sound fairly sanguine and balanced about, inflation. At the same time, I think what we need to keep in mind is they seem to be very comfortable from the growth point of view. And like Latha also mentioned, we were expecting there was some probability that a 7.4% as indicated in the bulletin could have been revised up as GDP growth. But that too hasn't been revised. But we clearly know that there is an indication of an upside that they are seeing on growth front after the bulletin data was out. So I think all in all, this is clearly wherein it gives them fair amount of room to wait and watch and let data determine eventually. There are fair amount of risks on the food inflation side. And that is the reason there seems very limited room for RBI to act in the near term. So they will be really looking very cautiously on most of the inflation-linked data and, of course, the global cues. And that's when they can consider change, but that doesn't really happen in H1 at all.
Well, Kaushik, what did you make of the policy, reading between the lines of what the governor said? Of course, overall, it was as expected, but, no revision in that growth forecast that everyone's been talking about, Kaushik.
I think it's a very prudent move not to hike the growth forecast too much, because 7% is quite a good number for FY25. Remember that the more FY24 gets revised up, the base effect becomes more challenging. So to that extent, getting a 7% growth number and not revising it higher, obviously that's a very prudent move, because there are lots of risks on the horizon which could lower growth expectations going forward. It's not just what growth numbers you're getting at this point of time. What is important to also ascertain is 2 quarters or 3 quarters down the line how growth will look like. And there is a bit of uncertainty. So I think 7% is a good number to work with in FY25. The other surprising fact was, despite governor talking a lot about inflation risk, if you see 3 quarters out of the 4 quarters, inflation has been revised downward. And April, June, there could be heat waves and all, but they have revised both the inflation forecast from 5 to 4.9. Even July, September from 4 to 3.8. And more importantly, January, March of 25, from 4.7, they have revised it down to 4.5. So obviously, that's a bit of surprise. If you are hawkish on inflation, then they should not have touched the inflation forecast. Whatever was there was okay, and there was no need for tweaking at this point of time. So that also comes to me as a bit of surprise. But the one thing which obviously is not mentioned, but that will play on the policymakers' mind. Maybe RBI will not talk about it openly, is what happens with the Fed interest rate cycle. So if the US Federal Reserve is kind of delaying their rate cuts, or if they are not going to cut at all in this year, like Neil Kashkari mentioned yesterday, then obviously RBI's hands will be also tied of not providing any monetary easing. Now, RBI will not come out and say that it would kind of the decision would depend directly on the Fed. Probably it doesn't depend directly on the Fed, but to a large extent, what the Fed does and how they kind of guide the market will have repercussion for RBI policy as well. So that is something which we need to look out for, when the Fed will start cutting rates and how much they cut this year versus next year, which will also determine RBI's rate cut actions going forward.
Okay. Got that, Kaushik. Let me get to the bond guys now. Shobit, after listening to the governor, any change in your expectation of when the first rate cut will be?
Latha, I think the policy, as we've all just said, it was exactly on expected lines, no surprises. Given that, even though we would not want to admit, but everybody looks up to what the Fed does. And if the Fed is going to perhaps start the easing cycle with the first rate cut in June, my own guess would be that perhaps RBI could consider an August cut if inflation moves in line as per expectations in the next few prints. However, I think the focus at this stage for the market is policy is behind. It's more about the auction today. We have the first multiple price auction of the 10-year benchmark. It's a large auction, 38,000 crores total, 20,000 crores is the new 10-year benchmark. So I think the market is far more focused today on what the cutoff is likely to be on the benchmark today, because that would be what market would be looking for from RBI from a signaling point of view. Because as you have said, yields have hardly budged because this large auction is pending, and entire market is focused towards what kind of cutoff are we likely to see in the auction today.
Fair point. Well, same question to you actually, Sandeep. Any change in terms of rate cut expectation? The majority I got was August to October, but more leaning towards October.
No, absolutely, Latha. I would echo what Shobhit just mentioned. I think a large part of RBI decision making on when the first rate cut would happen would still be linked to when the Fed cuts the first time. And frankly speaking, it's very data dependent, be it India, be it US. And suddenly, it's very difficult to pinpoint whether it's going to be August, whether it's going to be October, or it could even be delayed if data keeps on coming stronger. So we don't really have want to pinpoint when the rate cuts would be. I think largely from how we position ourselves and how we see the markets, we really don't see too many risks of yields rising up because certainly rate hikes are off the table. And as a positioning part, then we prefer to be long, and we are not trying to probably look at the path dependency, but we do know that the next move is lower for the yields.
Well, we quickly, Upasna, a word from you. The monetary policy report is out, and the FY26 GDP projection here is 7%. That is a flat growth is what RBI is expecting from the 7% again in FY25. And in FY26, the quarterly growth rates are seen in the range of 6.7 to 7.4%. We'll get you the CPI estimate as well in just a bit. But Upasna, what did you make of this number?
I think RBI is clearly not accounting for the global slowdown, which may be delayed for sure, but it will be coming about in probably a couple of quarters. And that is where my fear is that RBI will be missing the target of even 7% for this year and even for next year as well. We are at 6.6% for this year, and the next year we are at 6.5%. So we do see 40 to 50 basis of a downgrade to RBI's estimates, largely because I do not expect the stability in global growth to be maintained through the course of next 2 years. I think we will be seeing a reasonable amount of slowdown. And talking about FY26 inflation, I think they're expecting 4.1% in the MPR, as you mentioned. So 4.1% is something which is achievable. We too are at 4.2% inflation for next year, which also suggests that there will be room created for rate easing in the second half of the year. So if all goes well, growth may have to be revised down, while inflation approaching towards 4% average, 4.1%, is something which further probably validates the case that rate easing is in the offing, just that it may be delayed depending on global and domestic parameters that we have to look at.
Okay, thank you very much. Our entire set of guests, Mr. Shetty, Shobhit, Sandeep, Upasna, Kaushik, for reading the fine print and telling us how you expect things to pan out from here on. It is, of course, one of the most unexpected lines policy. Even the minor higher expectation of growth has not been acceded to by the governor. He is stuck to the knitting of 7%. And that's, I think, a very wise thing to do when you have an election backdrop. It's not that this election is going to throw up much surprises, but considering that it's a lame duck government, the governor should not ruffle feathers. So he's been as even-toned as he could be, and perhaps as he was largely expected to be. This LCR paper is just going to be something that's going to be a discussion paper, and it will not be much tweaking. It is LCR is just the liquidity coverage ratio, the amount of money that any bank has to keep as a percentage of its deposits as easily liquefiable cash. That's the meaning of LCR. It actually aligns with the SLR. So it's about 20%, give or take. The LCR tends to be a little lower than the SLR, but that's unlikely to change things much. So it's really, as expected, a BAU policy, business as usual policy. But we will have to see what comes out of the press conference. There are going to be questions, of course, which Ritu will ask the governor, as will other reporters, on why there have been such a series of actions on the NBFC companies. What has the governor and the RBI thought through in terms of currency derivatives and the underlying required? So the press conference is always going to be the most important and interesting in the Reserve Bank's monetary policy. This is only Act 1, which has ended with flat markets. Market is at 7.1 before the policy began. I mean, the bond yields. It is 7.1 right now. so much for the impact of the policy. Ritu, Ekta, thank you very much. And of course, I will be listening to you at the press conference. That's it on this Act 1 of the monetary policy. At 12, it will be Act 2.